got the lovely Felix in the studio. Hello.
Hello.
It's been a while.
It has been a while indeed.
So how is everything going? I mean, this interview is going to be, I think, full of questions, isn't it?
Probably, yes.
So much going on due to the coronavirus.
Yes.
And the stock markets.
Yes.
Felix, tell us more.
So, if you have investments, you may be slightly worried at the moment because on Monday, well, in the lead up to Monday anyway, the market has generally been a downward spiral because the world has been reacting to the coronavirus. And then over the weekend, Saudi Arabia and Russia decided that they're not going to give up on their oil production. So it sent oil to sort of historic lows. And that has a almost bigger impact on the stock market than the coronavirus because oil is a lot more important to the world than a virus,
yes.
Believe it or not. So that really has meant that big oil companies, so Royal Dutch Shell, for example, which was the biggest company on the FTSE 100, shed sort of 30% of its value in one day. No. So that has a disproportionate effect on the rest of the FTSE 100. Because it's the FTSE 100, the way it works, it's by market capitalization. So the bigger companies have a bigger impact if they fall than a smaller company on it. So company number 1 will strip more points off than company number 100. So that's the way it works. However, what I would encourage and stress to everyone is that if you don't need to access the money, don't access the money. It's as simple as that, really. I know it's very, very hard because it plays with your psychology. You don't really want to lose money. No one likes losing money. No. But you need to remember that you haven't lost money unless you sell and incur that loss. And if it's for the longer term and you sell now to search for some safety, you have incurred that loss. And you may wait 6, 12, 18 months to reinvest, but you've lost out over all that time. And again, it's important to remember as well, the best days on the stock market have always followed the worst days on the stock market. Right, okay. So I can't remember the exact statistic it is. It's something like if you invested in the S&P 500, which is the American stock market, and you'd missed the 10 best days over the, I think it might be 30 years, might be slightly longer, your return would only be 98% as opposed to about 14,500 if you'd encashed and missed out on those 10 best days. So really, it's something to bear in mind. If you're investing for the long term, don't worry about it. If you've got a pension that's invested in your young, don't worry about it because you couldn't access that anyway. You have to ride the storm. That's why it's great, really. If your money's locked away, you can sort of ignore it because it will rise. And markets always fall and markets always rise. It is the nature of the beast.
Yeah, absolutely, absolutely. And that's the thing. I think a lot of people are going to be worrying. So what I thought is we could have like a 2-minute break now, 3-minute break, and see if anybody's got any questions. They can ring into the studio and maybe we can answer a couple live on air.
Yeah, that's a good idea.
Let's do it. I'm joined in the studio by Felix Milton. Good morning again. Nearly said afternoon then. Not quite. So we opened the phone lines up and we've had a couple of calls. Now our first call is from Christina and she has said, is the Volatility a good buying opportunity?
The volatility.
Volatility.
Yes. So volatility is usually actually a very good opportunity to buy into the market, but you need to be aware that you're never going to catch the bottom of the market and you're never going to catch the top of the market as well. So buying in volatile times often means that you'll actually buy more stocks for your money. And if you're investing on a regular basis, you benefit from what's called pound cost averaging. So that term sounds rather sort of mathematical, which it is to an extent, but what it means is your regular contributions or your buying in a falling market means that as the value of shares fall, you of course are buying more shares each time for the money that goes in. So say a share is £2 and you're buying at that. If it goes to 150 and you're still buying, you're obviously benefiting because you've got more shares. And if it goes to £1, you're buying twice as many shares as you are buying at £2. So that's how pound cost averaging works. And then on a subsequent recovery, you will benefit from a big uplift in those overall values because in theory, you've got more shares. So that's the logic behind pound cost averaging, which is your friend in volatile times. And if you're investing for the longer term, investing as much as you can now to take advantage of some cheaper stocks than they otherwise should be.
Yeah. And like you said before, we do have these ups and downs in the market. And if you've got it for the long term, there's no need to panic because it will rise again.
It will. And it's not, if you've got a broad basket of holdings within your accounts, you don't need to worry about it. If you are just invested in 3 stocks and they've fallen probably worry a little bit more, because really you should be more diversified than that.
Okay.
I mean, lots of, especially the elderly generation, like buying their Shell, like buying their BP, as those companies traditionally have been the biggest dividend payers historically. But as we go forward into the future, you need to consider that now, yes, the oil price is really low, so that's had a knock-on effect on those companies' share price and in turn their dividend yield, as in future years, if oil stays this low, they'll make less profit, so they'll have less to distribute. But you also need to remember that we're going towards a carbon neutral economy. So by 2050, if we hit those targets, where's oil going to play in that? And now BP and Shell are sort of bad examples for this argument, really, because they're some of the biggest investors in renewable technology. But some oil companies will disappear, as is the nature of the thing. There'll be consolidation in the industry because oil will hopefully become used less and less as we go forward. So it's something to bear in mind there if you are holding just such a very concentrated basket of holdings.
Yeah, and really, if you wanted to expand on that is a possibility, is it?
It is, yeah. I mean, you could potentially invest in, if you want to just invest in the market, you can buy what's called a tracker fund, and that just buys everything regardless. It doesn't care if it's a bad company or a good company in theory, it will just buy those things. And that's the easy way to get diversified market exposure.
Yeah, excellent. Now, another question we had as well is that today, interest rates, they have been cut. So how could that affect their money?
So interest rates have been cut, and so that will have an impact on you if you're planning to go abroad, because typically when interest rates are cut, it means that the value of the pound appreciates.
Okay.
So that's the first thing. However, you're probably not going to be going abroad much at the moment anyway, but that could affect if you have some overseas holdings priced in, say, dollars, and how much that will have a knock-on effect on the valuation there. Interest rate cuts also will have an impact on your savings. It will take a little while to filter through, but it may mean that we're seeing sort of banks cut their rates again, and we're back to those historic lows. And Mark Carney said he's not ruled out even further cuts. I mean, in some European countries, such as Sweden, they've had negative interest rates, believe it or not, for a period at the base rate. So you may be earning nothing. It could get worse. So one way of beating that is, yes, all this market volatility is there, but dividends are still being paid. Companies are still making profits. Tesco will still be selling toilet roll, and as will all the other supermarkets, and make a profit from doing that. So it's important to remember that companies will stay profitable. They may make less profits, but even after a big financial crash, as was seen in 2008, 2009, dividend income, which is the profits the companies made, recovered a lot more quickly than their fundamental underlying share price. So if you're looking to invest and want an income, invest, ignore what the capital value is doing. So pick your 20,000 in. Doesn't matter if it goes to 18,000, doesn't matter if it goes to 22,000. You know you can consistently take an income from that year in, year out, and that's what you could be enjoying.
That's what you could be, and like you say, it's all about planning as well, isn't it?
It is,
Speaking to people like yourselves that actually know where the best place to put your money is.
Yes, and where we are now as well, the important thing to remember is we're coming up to the end of the tax year. So I want to do a sort of shout out to the allowances that you've got available. So you can claim the marriage allowance transfer. That's great if you're a couple and you're married and one of you is a basic rate taxpayer, the other is a non-taxpayer. The basic rate taxpayer can have 10% of the non-taxpaying spouse transfer their personal allowance transferred to them, so they can earn a greater amount. It'll save them about £250 a year. And you can backdate it as well if you haven't done it before, but you can only backdate it 4 years. So we're going to drop out of the oldest year if you don't claim by April. So claim now, and then it will carry on in perpetuity. So that's a great one. Another one is ISA allowances. £20,000 can go into a cash ISA, stocks and shares ISA, and you get that tax-free. So any growth on that is tax-free. Any income received within that's tax-free. If you're under the age of 40, open a lifetime ISA. You can put 4,000 in it. The government will add 1,000 to that. So that's another tax freebie for you. And if you are close to retirement and you're a sort of a higher earner, make sure you're maximising those pension contributions if you can afford to do so, because you're going to benefit from tax relief on that money going in. So just to encourage everyone to make use of their allowances before you lose them at the end of the tax year.
So you've got until the end of April to make sure.
No, the end of March. So the 5th of April is.
Oh wow, okay, sorry, so the end of March to get in and get any allowances that you could be entitled to.
Yes, exactly, and you don't want to let those go to waste, because a lot of them, once you don't use them, you've lost them. So really, you want to make sure you're using these when you can.
Absolutely. Felix, it's been great again to have you in the studio. Thank you so much for coming in. I'm sure there are a lot of, because you do see on the news at the moment, you see a lot of these big red falls where they're saying everything's crashing, it's the lowest crash for years. And it is worrying when you're sat at home watching it.
It is. And everyone's human. And even I find it hard sometimes to think, oh, it's gone down a bit. But you need to remember that the fundamentals are still there. And if you can sit tight and know it's for the longer term, you don't need to worry about it, because the news likes to portray the doomsday theory with regard to the markets. But if you can sit tight and ignore it, great. You're probably going to do better in the longer run.
Fantastic. Thank you so much. Look forward to having you in the studio again next month.
Yes.
And hopefully with lots of good news.
Hopefully, yes. Have to wait and see.
And if anybody wants any information, or if you've got any questions, whereabouts are you based, Felix?
So I'm based at Philip J. Milton and Company in Barnstable, and you can reach me on miltonpj.net, or if you try and telephone the office, or you can even reach out to my Facebook page, Finance with Felix.
Fantastic. Thank you very much. See you soon.
Thank you. See you soon.
Bye.